The last time the Fed faced a debt crisis like today, one single asset went up over 1,600%. Not 16%, not 160%, 1,600%. And right now in 2026, we are facing the exact same pattern. Again, history doesn't repeat, but it rhymes. We have $39 trillion in national debt. Our economy is $32 trillion large. That means we owe more than we produce, every single year. The Fed's decision in the next few months will make some people incredibly wealthy and leave everyone else behind, again. First, you need to understand what the Fed actually is. It is not a bank, not a reserve, not federal. It says so right on their own website, but it controls every dollar in your wallet. But here is what it can do. It can raise interest rates, it can lower interest rates, and it can print money out of thin air. These three levers control the entire economy, and every time the Fed pulled one of these levers in the last 50 years, the same pattern happened. Average wages did not keep up with inflation. The average person got poorer, but asset owners got incredibly wealthy. 3 times in 50 years, 3 different crises, 3 times the average person lost ground, and 3 times the investors won. Cycle 1, the 1970s stagflation crisis. The Fed raised rates all the way to 20%. Cumulative inflation over 5 years, 52%. Wages grew only 36%. That gap, 16%, came out of your pocket. But here is what happened to assets in those same 5 years. Stock market, up 54%. Real estate, up 36%. Gold stayed flat, too volatile. And the biggest winner? People holding bonds earning 15% interest per year. Lesson from the 1970s. When the Fed raises rates, cash and bonds win. Stocks still beat inflation. Gold was a wild ride. The loser? Anyone just holding dollars. Cycle 2, 2008, the housing crash. The Fed cut rates and printed money. Cumulative inflation over 5 years, 11%. Wages grew only 7%. Same pattern, average person gets poorer. But look what happened to assets in those same 5 years. Stock market boomed 200%. Real estate recovered, up 50%. Gold shot up 70%. Bitcoin did not exist yet. The Fed printed money, and asset owners printed wealth. Lesson from 2008. When the Fed cuts rates and prints money, stocks, real estate, and gold all win. Bonds lose, cash loses. The pattern is clear. Cycle 3, 2020, the pandemic. Rates cut to zero. Money printer on full blast. Cumulative inflation 2020 to 2025, 25%. Wages grew only 20%. Third time, same pattern. Average person loses. Now look at what happened to assets from 2020 to 2025. Stocks, up 160%. Real estate, up 45%. Gold, up 125%. And Bitcoin, up 1,600%. From $7,000 a coin to over $100,000. Why did Bitcoin explode? Simple. When rates hit zero, institutions had cheap money. They needed speculative assets with high upside. Bitcoin was the perfect target. Now here is the problem in 2026. Debt to GDP ratio, 122%, the highest since World War II in the 1940s. Back then it was 121%. We are in uncharted territory. The new Fed chair is Kevin Worsh, started May 15, 2026. Trump wants lower rates. Worsh says, not so fast, inflation is a problem. And there are 12 voting members at the Fed. Kevin Worsh needs 7 votes to move rates either way. 2 scenarios, 2 very different outcomes. Scenario A, Fed cuts rates. Speculative assets, stocks, Bitcoin, gold, all boom. Scenario B, Fed raises rates. Cash and bonds win. Speculative assets struggle. So what do you actually do with your money? Here is what history tells us works regardless of what the Fed decides. Investment idea number 1, broad stock market. The S&P 500, 500 largest companies in America. Funds like VOO give you exposure to all 500 at once. Rates go up, stocks still win long term. Rates go down, stocks win even bigger. It works both ways. Investment idea number 2, real estate, physical properties or REITs on the stock market. REITs must pay out 90% of profits as dividends. That means regular income plus price growth. Investment idea number 3. If Fed cuts rates, speculative assets. Bitcoin went from $7,000 to over $100,000 last cycle. Growth ETFs like VUG, higher risk, higher potential reward, only if you understand what you are buying. And investment idea number 4, inflation hedge, gold and tips. Gold went up 70% in 2008. Gold went up 125% after 2020. When people fear inflation, gold wins. Tips adjust your return based on the actual inflation rate. You now understand what most investors never learn. 3 Fed cycles. 3 times the pattern repeated. Asset owners won, cash holders lost. The next cycle starts now. Watch this next video. Learn exactly where to start.